Have you ever wondered what the future of money looks like? We hear a lot about cryptocurrencies like Bitcoin, but there's another major revolution brewing, one that's being led by the very institutions that manage our money today: central banks. This revolution is called Central Bank Digital Currency, or CBDC, and trust me, it's going to change everything. So what exactly is a CBDC? Is it just a government-run Bitcoin? And how will it affect your daily life, your savings, and your privacy? Stick with me because today we're diving deep into the world of CBDCs to uncover what they are, how they work, and what they mean for you. First, let's break down the basics. Think about the money you use every day. You probably have some physical cash coins and banknotes, and you definitely have digital money in your bank account. When you use your debit card or a payment app, you're using commercial bank money. This is essentially a digital IOU from your bank. A CBDC is different. It would be a direct liability of the central bank, just like physical cash is today. In simple terms, it's digital cash, issued and backed by the government. So instead of your digital money being a claim on a commercial bank like Chase or Barclays, a CBDC would be a direct claim on the country's central bank, like the Federal Reserve or the Bank of England. It's the digital equivalent of holding a dollar bill, but on your phone or a smart card. So how would this even work in practice? There are a couple of main models being explored. The first is the retail or direct model. In this setup, you and I would have accounts directly with the central bank. Imagine having a Fed app on your phone where you could hold your digital dollars. You could send money to your friends, pay for your coffee, or receive your salary directly into this account, bypassing commercial banks entirely. This is a huge shift as it would fundamentally change the structure of our banking system. The second and more likely model is the wholesale or indirect or two-tier model. In this system, the central bank would issue the CBDC, but commercial banks and other authorized financial institutions would handle the distribution and all the customer-facing services. So you'd still use your regular banking app, but the money you're moving around would be CBDC. The commercial banks would act as intermediaries, managing your wallet, handling customer service, and performing Know Your Customer checks. This model is less disruptive to the current financial system and leverages the existing infrastructure and expertise of commercial banks. Most countries, including the ones leading the charge, seem to be leaning towards this two-tier approach. Now you might be thinking, this sounds a lot like the digital money I already use. What's the big deal? That's a great question, and the differences are subtle but profound. Let's start with the benefits. First and foremost is safety. Your money in a commercial bank is insured up to a certain limit, but there's always a tiny theoretical risk of the bank failing. With a CBDC, your money is a direct claim on the central bank, which cannot go bankrupt. It's the safest form of digital money possible. Second, efficiency and cost. CBDCs could make payments faster, cheaper, and more efficient, especially for cross-border transactions. Sending money internationally today can be slow and expensive, involving multiple intermediary banks. A CBDC system could potentially allow for instant, near-free international payments, which would be a game changer for businesses, migrant workers sending remittances, and travelers. Third, financial inclusion. Billions of people around the world don't have access to traditional banking services. A CBDC could change that. If all you need is a basic smartphone or a simple payment card to access the financial system, it could bring millions of unbanked individuals into the formal economy, giving them access to secure savings and credit. And finally, for the governments and central banks themselves, CBDCs offer a powerful new tool for monetary policy. For instance, in a severe economic crisis, a central bank could directly deposit stimulus funds into every citizen's CBDC wallet. This is much faster and more direct than sending out checks or relying on banks to pass on rate cuts. They could even, in theory, implement things like negative interest rates more effectively, though that's a very controversial idea we'll touch on later. Of course, it's not all sunshine and roses. The prospect of CBDCs raises some serious concerns, and the biggest one is privacy. With physical cash, your transactions are anonymous. No one knows you bought that extra slice of pizza. With a CBDC, every single transaction could be recorded on a central ledger. Who has access to this data? The government? The central bank? Law enforcement? This creates the potential for unprecedented surveillance. Imagine a world where the government knows every single purchase you make, every donation you give, every service you pay for. This is a huge concern for privacy advocates. Now, central banks are aware of this. They are exploring various models for privacy, from fully anonymous systems, which are unlikely, to pseudo-anonymous systems where your identity is protected but can be revealed with a court order, similar to the current banking system. China's digital yuan, for example, is experimenting with what they call controllable anonymity. It's a delicate balance between preventing illicit activities like money laundering and protecting individual privacy. Finding the right balance will be one of the biggest challenges in designing CBDC. Another major risk is the potential disruption to the banking system. If everyone decides to pull their money out of commercial banks and hold it in super safe CBDC wallets, what happens to the banks? Commercial banks use our deposits to lend money to individuals and businesses. This credit creation is the engine of our economy. If they lose a significant portion of their deposit base, their ability to lend could be severely constrained, potentially leading to a credit crunch and an economic slowdown. This is why most central banks are favoring the two-tier model and are considering things like putting a cap on how much CBDC an individual can hold to prevent a mass exodus from commercial banks. And then there's the concern about government control. A programmable CBDC could give governments immense power. For example, they could put an expiry date on stimulus money to force you to spend it quickly. They could block transactions for certain goods or services they disapprove of. Or they could automatically deduct taxes or fines from your wallet. This moves into dystopian territory for many people, and it's a legitimate fear. The design of the CBDC and the legal framework around it will be absolutely critical to prevent such overreach. The technology itself is neutral. It's how we choose to implement and govern it that matters. So, who is actually doing this? It's not just a theoretical concept. Over 100 countries, representing over 95% of global GDP, are exploring a CBDC. The Bahamas already has a live CBDC called the Sand Dollar. Nigeria has the Naira. But the big player everyone is watching is China. Their digital yuan, or ECNY, is in advanced pilot stages with millions of users. They've integrated it into popular payment apps like WeChat Pay and Alipay and have tested it for everything from public transport to online shopping. China's goals are multifaceted: to increase the efficiency of its payment system, to challenge the dominance of its tech giants, and to increase the international use of the yuan. In Europe, the European Central Bank is deep into the investigation phase for a digital euro, with a potential prototype on the horizon. In the United States, the Federal Reserve has been more cautious. They've published discussion papers and are researching the pros and cons, but they haven't committed to issuing a CBDC yet. They're taking a slow and steady approach, wanting to get it right rather than just be first. The rise of CBDCs is an unstoppable trend that is set to redefine our relationship with money. It promises a future of safer, faster, and more inclusive payments. But it also comes with significant risks to our privacy, financial stability, and personal freedom. As this technology develops, it's crucial for us, as citizens, to stay informed and engage in the conversation. We need to demand that any CBDC is designed with robust privacy protections and strict legal safeguards against government overreach. The future of money is being designed right now, and it will affect every single one of us. It's a revolution, and it's happening in plain sight. Thanks for sticking with me through this deep dive. I know it's a lot to take in, but it's incredibly important. What are your biggest hopes or fears about CBDCs? Let me know in the comments below. I read every single one. And if you found this video helpful and want to stay ahead of the curve on the future of finance, make sure to hit that like button and subscribe for more content. See you in the next one.